Welcome to TheoTrade. This is Don Kaufman. It's July 11th, 2018. You are watching the Theo Night video. Let's get started with looking at a couple of the major indices. So, last night they announced more, trade war, and immediately the markets reacted. Some pretty heavy sell-side activity last night in the S&P futures specifically, but they recovered on a percentage basis. The Nasdaq continues to kind of outperform, and not surprising, the Dow. In fact, if you watch Monday's video was, do you really trust a market where the weakest stocks happen to be leading? And it was specifically the Dow that we were picking on the other day, because it was Dow underlyings, including Caterpillar and Boeing, that were carrying the market to the upside on Monday. Nevertheless, if you're unaware and have not necessarily looked at a couple of individual stocks today specific to, Caterpillar down over 3%, Boeing down almost 2% today. Those underlyings obviously got hammered. So, what we mentioned on Monday kind of came to fruition. Let's kind of get to work today. There's quite a bit to discuss in today's market action. One of the first things that grabs me is the fact that volume inside of the S&P futures today, it was still a little bit lackluster given the fact that the S&Ps were down 21 handles. Again, the volume picked up a little bit. We're talking like 1.3 million contracts. People, that's really light commitment in terms of trading activity. It's just, that's not exactly happening. Then I looked over at the volatility futures. Now, the volatility futures that I will look at, are not the shortest duration volatility futures. I'm no longer looking at the VXN9. Why? Because they only have 7 days left to live. I've actually bumped out and I'm looking at the 42-day volatility futures. So why am I now looking at the volatility futures? Well, anytime a bout of volatility hits, I have tendency to look at, for example, here, the 1485, which is the August volatility futures versus, for instance, the 70-day volatility futures. And I'm looking for the gap between them to kind of narrow. And what we talk about with contango and or backwardation, and the lines I'm drawing would be, consistent with contango or backwardation. And again, what you're seeing here, yes, the risk picked up today, but we have nothing extreme, which is also, again, being pointed out by the fact that the lack in the complacency, lack of volume and a little bit of complacency inside of the marketplace. However, there is one interesting thing that I think a lot of people are going to miss. And any evening that you tune into one of these videos, I like to make it worth your while. I like to find something that maybe you weren't necessarily looking at. That has to do today specifically with the VVIX, the volatility of the Volatility Index. Now, again, if you're unfamiliar with the volatility of the Volatility Index, all it measures is 30-day volatility, specifically on the VIX. And it was bid up. It was bid up to a tune of about 13% today. So I went over and I looked at the VIX. Now, the VIX itself, forget that it's up a point. That's neither here nor there. The reason I'm looking, at the VIX, and specifically I'm looking at the VVIX, is I want to see the activity in the options. I want to see, what's going on in here. And sure enough, the volume in the VIX itself is almost 2 times the norm. The sizzle index, for those of you that have no idea what that means, it's today's option volume versus the previous 5 trading days options volume. And there's no question that the volume in the VIX itself, is consistent with, there's big time hedging activity. And any time that there's big time hedging activity, and how do I know it's big time hedging activity? Well, listen, if you're out there and you're trading in the VIX, and you know that these traders are buyers of VIX options. How do I know they're buyers of VIX options? Because the volatility of the VIX, the VVIX, is up some 13%. So we know they're buyers. We know that the activity is heavy in there. Predominantly, they're going to be hedgers. That is, they're coming in there and they're actually using defensive methodology and defensive logic inside of the VIX. Anytime you see that, you should be a little bit nervous. Why? Well, it's a duck and cover kind of strategy. All right, because there's some uncertainty, obviously, inside of today's marketplace. Now, here's one that kind of baffles me a little bit today. And this is, I don't mind saying, what are you possibly, baffled by? Well, there's 2 major areas that we've been kind of keying into on a day-to-day basis. And for those of you that do not necessarily tune in on a day-to-day, let me get into it. One of them happens to be specific here to the XLF, which I did a horrible job of trying to circle. But the XLF, it's not even down but 0.5%. It's only off by about 13 cents. So the XLF, and again, this is the financials, and the financials, Why do they really matter this week? Because they have earnings coming out this Friday. Here we are Wednesday, they're coming out Friday, it's going to be a party. The financials bounced off of an absolutely critical threshold of 26.50. They bounced back up. And for those of you not aware, it was like once, twice, 3, 4 times, I don't know. 5, 6 times we've bounced out of this area. The financials are breaking under 26.50. That's the sign. What sign? Well, that'd be the sign of a larger breakdown inside of the S&P 500. And again, they bounced earlier this week and they faded a little bit today. But here's what kind of baffles me about it is you got the financials, they faded a little bit, mildly. Okay, they actually outperformed the S&P on a percentage basis, right? They're down just about 0.5%. The S&P is down 0.8%. But also what outperformed happened to be none other than the monsters of tech. And the interesting irony of today's trading session is all that's driven us in trade lately, all that's driven us has been the financials, has been the monsters of tech. And yet the S&Ps are down 22 points, okay, with the fact that the financials aren't that weak and technology isn't that weak. Okay, which leads us to believe everything's about energy at this point. So energy itself, and a lot of people kind of discount energy. They're like, it doesn't really matter anymore. Yeah, well, apparently it does because it dragged the S&Ps down some 22 points. And what was really kind of on the leading edge of the marketplace took a little bit of a back seat today. One other aspect I've been looking at in today's trade, the markets are darn near correlated. When I say correlated, when you're looking at a down day, you want to see about 90 products on one side of the marketplace to see what we term correlation. That would be something like 90-10 inside of the S&P 100. Why? What does that mean? When you see 90 products on one side of the marketplace, it means the S&Ps or the Nasdaq futures, that means the futures markets, they're gripping hold. Okay. In effect, what it means is don't worry about individual stocks. Start worrying about the marketplace as a whole over here. Now, with all of this going on, okay, what can we actually kind of surmise from it? Again, the financials, this is a coin flip. And I'm going to tell you why it's a coin flip, because the earnings are coming out. All right, JP Morgan, Bank of America will actually be on Monday. But again, we have a slew of financial earnings that are going to be headed out. And this is the coin flip, though, that really determines a significant amount about the marketplace. What leaves me incredibly uneasy, though, about the entire marketplace is now we are actually seeing definitive buy-side activity. Again, definitive buy-side activity in the volatility of the VIX. Okay, you're not going to see it in the VIX. Nobody's going to come into the SPX anymore and go, I'm buying puts. Okay, nobody wants to show their hand. They don't want to show their cards. So they come in ever so quietly. They buy up options inside of the VIX. Not too many people look at the VVIX, but that's the place to be. Now, I'm going to completely switch gears with you because I've left you in a little bit of a lurch for the remainder of this week, and rightfully so, because the marketplace, okay, is highly scattered, a mixed bag of goods. Speaking of highly scattered mixed bag of goods, EEM, well, apparently this was what we mentioned, okay, nothing more than a bounce because there's more sell-side activity. We'll look to see if EEM continues to have some of this downside action. If EEM bounces in the next day or two, I'm going to re-up another short position inside of the emerging markets. Okay, now let's get to a completely different conversation over here for just a moment, and something that I really wanted to mention and was talking a little bit about in the TheoTrade chat room today, but figured it was well worth mentioning on this evening's video. And it has everything to do with what we term stock buybacks. Okay, so for those of you unfamiliar with the term, there is something called stock buybacks, and that's a company. Could be something like Microsoft. All right, I'll give you a quick example over here. Microsoft. I remember when Microsoft had, well over 8 billion shares. Again, 8 billion shares in the float. Now, Microsoft's actually down to, 7.6 billion shares inside of the float. So what effectively is going on? Well, they're buying back their own stock, and they're buying it back in record fashion. Now, I'm not picking specifically on Microsoft, but there was something that I mentioned in a video way back at the beginning of the year. There was a shocking number that was released, and I'm going to write it up here momentarily. There was a shocking number that was released by JP Morgan. And again, it was JP Morgan. It was an analyst at JP Morgan that released this number. But JP Morgan had forecasted for 2018, okay, buybacks to the amount, get this, to the amount of 842 billion. That is what JP Morgan specifically, that was forecasted. Again, that was an analyst, JP Morgan. Give credit where credit is absolutely due. Okay, so now let's fast forward. We just got through, the first half of the year. We're into July. It's a party over here. By the way, JP Morgan, a lot of their buybacks were predicated on the idea of repatriation of cash, right? The tax plan changed everything. Big companies like Apple were just taking a vacuum, pulling money from Europe, bringing it back into the U.S. Okay, the actual announcements of buybacks are already at 680 billion, and that, people, is in the first 6 months. So we are actually ahead of what we would call an absolutely ridiculous run in terms of stock buybacks. Again, we were forecasting 842 billion, which everybody on the street said was just a ridiculous number. But no, we've already done basically 680 billion. That was actually announced, okay, which we still have another 6 months left in the year. But I wanted to look deeper into this, and I'll tell you why I wanted to look deeper into this, because in several of the articles, and one of them that was specific from actually an analyst over at Merrill Lynch, is they said that literally the only people that were buying stock right now, the only people that were buying stock happened to be very specific, okay? It was the companies themselves, and that retail clients weren't even buying anything. So I wanted to actually do some due diligence on this because, again, that was very much more of a sentiment driven that Merrill Lynch went out and said, well, we pretty much believe that, the only person doing stock buybacks happens to be the companies themselves. So what I did, and I'm actually going to explain precisely what I did over here, is I looked a little bit into this using the TD Ameritrade Investor Movement Index. If you have no idea what this is, okay, well, I'm going to give you a quick lowdown on the TD Ameritrade Investor Movement Index. During my time at TD Ameritrade, so again, I was with thinkorswim very early on. TD Ameritrade bought us in 2009, 2010 timeframe. I remained there until 2015, but they developed what they call this IMX. And what an IMX basically is, it's almost taking like a delta, okay, and an aggregate of all the clients. Now, when I was at TD Ameritrade, there's about 7 million clients, but now, there's clear over, okay, like 11 million clientele. So it's like a delta of 11 million clients. And what they do is they aggregate the entire portfolio together. So it's not like looking at like, oh, let's look at Joey's account. Let's look at Mikey's account. They take the account, okay, as one big ball. And it's not sentiment. They're not asking a client like, do you mind? Are you bullish or bearish? It's nothing like that. They just take the overall delta, okay? Don't let somebody speak with their mouth. Let them speak with their wallet. And that's what this line happens to be. And you can see this is 2016, 2017. Now, the IMX is only given on a monthly basis. And you can see, it peaked out right here. What is right here? That's actually the very beginning, okay, of 2018. That's the year right there. And it's absolutely tanked. Had a slightest little uptick. So, in effect, Merrill Lynch is saying it's absolutely without unequivocation true. There are no buyers, okay? And you're like, well, why do you listen? Why do you care what TD Ameritrade does? Well, if you're unaware, they have the largest order flow in the retail by far. It's 11 million clients. These people they're doing almost 1 million trades a day. Almost 1 million trades a day are going through TD Ameritrade, okay? And what this is actually telling you is their clients, they just got out like there's no tomorrow. Month in and month out have been unloading. Yes, in the last 2 months, there's been a very, very mild bounce back, okay, of some of the capital in there, but it's negligible. At this point, okay, you got to look at this and you got to recognize ain't nobody buying. They're just not buying out there. And of course, everybody's going to point out, well, what about institutional investors? Well, Merrill Lynch had data on that, and the institutional investors are not net buyers of stock right now. And really, everything right now is being supported by the idea of simply stock buybacks. Again, an incredible thing. I think it's worth taking some time to look into this because in a rising interest rate environment, of course, I'm going somewhere with this. In a rising interest rate environment, okay, is it good to go out there and to put yourself as a company into deeper debt to buy back your own stock? You buy back enough of your own crap, you start to believe in it. Food for thought in tonight's video. Have a great evening, everybody. Bye-bye.